they bought government bonds, and when interest rates went up from 10-year note, treasury note yield to maturity went from like 1.75 to like 4. All those bonds lost 80% of the value. That's what happens on long duration bonds. Bond math is simple: rates up, price down, vice versa. Well, the rates were up, the price was down, so they were underwater and insolvent, and they got shut down. So Barney Frank's out whining the next day. He's like, hey, yeah, but that's true of every bank in the country. There's not a bank out there that didn't load up on treasury bonds at 1.75. They're all underwater. They're all insolvent. And by the way, the Fed announced a facility. They always have these 4 initials. I forget what this one was, a BA or whatever. But basically what they said was, if you're a member bank and you have treasury securities that are where the mark-to-market value is below par, so you paid 10 million, but they're only worth 8 million. And that was the case across the board. So like a trillion dollars or more of bonds that were in that category. You can deliver them to us, and we will lend you for 1 year the face value. So you're putting up 80 cents of collateral, but you're getting a 100-cent loan. I said, I got a 15-year-old car. Will you lend me what I paid for it? Because it's a lot more than it's worth now. But that's what they did. So now my head's spinning. I'm like, well, I get all this stuff, but I'm like, oh, so you just guaranteed every deposit in the banking system without limit, and you just guaranteed every treasury bond at par value without limit.
Yeah.
What's left? Like, what else do you have in your bag of tricks? Because you don't have it. There's nothing else you can do.
Jim Rickards unveils a critical financial juncture where government bonds witnessed an 80% decline amid soaring interest rates. Long-duration bonds, once stable assets, faced insolvency as their value plummeted, prompting shutdowns. Rickards narrates the Federal Reserve's swift response, introducing a groundbreaking facility enabling banks to exchange undervalued treasury securities for loans at face value. This move, as Jim underscores, effectively guaranteed every deposit and pledged unwavering support for treasury bonds, regardless of market fluctuations. In the face of unprecedented challenges, Rickards challenges the efficacy of the Fed's toolkit. He delves into the intricacies of the financial system's interconnectedness, drawing parallels to the dynamics of a viral contagion. As Rickards navigates through uncertainties surrounding the definition of systemically important, he invites contemplation on the broader implications of a financial system teetering on the edge, where government interventions raise questions about economic resilience and sustainability. With that, let's dive into the rest of the video to hear his full thesis.
Go back to 2008, they guaranteed every money market fund in the country. So, but here's Barney Frank whining, hey, yeah, my bank was in trouble, but so was every bank in the country. Why did you whack me and give all these guys a pass? Well, the answer is Signature Bank was another crypto bank. It had a portal called Signet, and Signet was a portal to the crypto world. And that's why they whacked it. Notice they whacked 2 crypto banks. So now it's Monday morning, where are we now? The 13th. Everyone's asking Janet Yellen, it's like, wait a second, what just happened? You guaranteed every deposit in the banking system. And she's like, well, no, not really. It's only if you're systemically important. And you're like, okay, could you please define systemically important so we can tell? Because we're getting our money out of all the banks that are not. And the truth is you can't, because the system is so densely interconnected. And this is why they say financial contagion. I mean, it's a metaphor, but actually the mathematics of a viral spread, we just went through a pandemic, but this has been true, for as long as it's been studied. The mathematics of viral contagion are identical to the mathematics of financial contagion. The equations are the same, the way it spreads. And of course, Janet Yellen can't define systemically important. Number one, they try, but they can't. Number two, I don't care how small you are. If you're a small bank and there's a run, the guy across the street, he's getting his money out of that bank. And again, it's like COVID. It's like it just keeps going until the system collapses, which means by definition, just by the dynamics, there's no such thing as a bank that's not systemically important, because they're all connected. Even the little banks are borrowing from the big banks, et cetera. So Janet Yellen hemmed and hawed and didn't have a good answer. She never does. She's not that bright. And so there we are. So the Fed has guaranteed every bond at par value, even if you're worth 20% less. And the FDIC has guaranteed every deposit. and Janet Yellen can't give you a good definition of what's covered and what isn't. Okay.
In this next clip, Jim Rickards unveils critical insights into the potential vulnerabilities of banks and how investors can assess their risk. Delving into recent events involving major institutions like Credit Suisse and UBS, Rickards hints at two pivotal metrics. He underscores the significance of evaluating the ratio of uninsured deposits to total deposits, emphasizing that when this ratio surpasses 30%, a bank becomes a potential risk. Drawing on Silicon Valley's example, where this ratio reached a staggering 97%, Rickards raises awareness about the precarious position such banks might find themselves in. Furthermore, Rickards introduces the importance of total assets, engaging a bank's vulnerability, distinguishing between those deemed too big to fail and a middle ground category with assets ranging from 100 billion to 400 billion. He also provides a list of what banks he thinks would have the highest potential to collapse next.
Now a week goes by. What's on tap for the next week? And again, Friday night press release, shotgun wedding, Credit Suisse and UBS. Now you're talking to big guys. These are two of the biggest, oldest banks in the world. I think Credit Suisse have been around since the 1870s, maybe, and I'm not sure about UBS, but they were the two biggest banks in Switzerland. So yep. Credit Suisse fails, and they get taken over by UBS. Okay, and now everyone's like, oh, what's next? Who's next? And there's a list. I'll go through it in a minute. What factors come into play? How can I think about whether a bank is likely to fail or not, regardless of whether they're getting bailed out? And there are two metrics that are really good. One is look at the ratio of uninsured deposits to total deposits. If that number is more than 30%, you're a sitting duck. And in Silicon Valley's case, it was 97%. They were 97% uninsured. So a little local bank that's got, I'll say 30% uninsured and 70% insured, they're very unlikely to have a bank run. Most of those customers are like, hey, I'm covered. I'm good. I got 100,000 in the bank. All good. But when you're up at the, north of 30, certainly north of 50, 70, 80, 90, you're an accident waiting to happen. Yeah. The other metric is total assets. So there really are too big to fail banks. Doesn't mean they can't fail, but it means they're 100% guaranteed to get bailed out. And that list is well known. So who's too big to fail? Like, you can put your money in, they can screw up really badly, and you're not going to get hurt as a depositor. Right. JP Morgan Chase, Wells Fargo, Goldman, the usual suspects, Goldman Sachs, US Bancorp, Capital One, TD, State Street, Citi, B of A, Morgan Stanley, PNC Financial, Bank of New York Mellon, Truist Financial, and BMO Harris. They're the giants. Okay. I'm not saying they can't fail. I'm saying that there'll be a safety net put under them, and no one's going to lose anything except maybe stockholders, but not bondholders, not depositors. But there's another category where you're bigger than the local savings bank, but you're not too big to fail. You're not on the list of giants. And these are banks with between approximately 100 billion and 400 billion of assets. When you get up closer to $1 trillion of assets, you're in the big leagues. But 100 billion to 400 billion of assets, you're big. You're not too big to fail, but you're big enough to take down the system if you do. And these are the ones that are vulnerable, and these are the ones where depositors and stockholders in particular, really need to drill down. I'm not saying get all your money out tomorrow, but the banks that fit that category that I just described: Citizens Bank, Manufacturers and Traders, Comerica, Webster, East West Bank, First Citizens Bank, City National Bank, not Citibank, but City National, First Horizon, Western Alliance, Valley National, Synovus, Frost Bank, Pinnacle Bank, Cadence Bank, BOK Financial, and South State Bank. That's the list of banks that are big enough to cause a systemic crisis, but not literally too big to fail. These are, and we, in our newsletters, we occasionally put out recommendations, not all at once, but buy put options on this bank because we think they're shaky. And remember, the stock can go way down, and the bank can still get bailed out. In other words, even if the bank gets bailed out and depositors don't lose money, it doesn't mean your stock can't go from 50 to 10. And that's no reason to buy a put option.
In today's eye-opening discussion, Jim Rickards delves into the intricacies of recent financial events, shedding light on the vulnerabilities of major banks. He subtly reveals crucial metrics that savvy investors should consider when assessing a bank's risk. If you found this information enlightening, make sure to subscribe for more thought-provoking content. Don't forget to hit the like button if you enjoyed today's insights and share your thoughts in the comments below.